Welcome back to Investing Talk Podcast.
Good, you back.
Today we're digging into Jaguar Health, that's JAGX.
Right.
You sent over quite a bit recent news from 2025, an April analysis, and a due diligence report from the same time.
Yes, a good snapshot of what's been happening recently.
So our goal here is to sift through this and pull out what's really important for you, the listener, to understand.
Let's get into it.
Okay, first up, some recent actions. There's this reverse stock split approved back in March 2025. Why does a company typically do something like that?
Well, there are a few reasons. Fundamentally, it reduces the number of shares out there, but boosts the price per share proportionally.
Okay.
Often, like the analysis suggests here, it's about meeting listing requirements.
Yeah.
Staying above that minimum price threshold for exchanges like Nasdaq.
Makes sense. Avoid getting delisted.
That's a big part of it.
Right.
It can also sometimes make the stock look, let's say, more substantial to certain types of investors who might shy away from very low-priced stocks.
Gotcha. Then there's this financing of private placement, 3.448 cents, closed in April. It's through convertible promissory notes.
Yes, that's right, convertible notes.
What's the deal with that type of financing, and where's the money supposed to go?
So convertible notes are basically short-term debt that can later be converted into company stock. It gives them cash up front.
For working capital, the sources say.
Exactly, working capital. And they specifically mention funding the development of crofelemer.
Their main drug candidate?
Correct. Particularly focusing on its use for rare diseases and managing diarrhea related to cancer therapy.
So it signals they're pushing ahead with that pipeline.
It does.
Yeah.
But it's worth noting, this kind of financing, while providing that needed cash, well, it can come with strings attached.
Like what?
Dilution risk. Because those notes can convert into stock later, it can mean more shares outstanding, which potentially waters down the value for existing shareholders. It's something you always have to watch with convertible debt.
Okay, something to keep in mind. Also, interestingly, they presented at the Elite PEGI Congress in Abu Dhabi. What does that tell us?
That really flags their focus on the gastrointestinal, or GI space, and specifically pediatrics PEGI.
Children's GI conditions.
Precisely. Presenting there suggests they're keen to engage with specialists in that field, share their data, maybe look for partnerships, or just build awareness for crofelemer in that niche.
Right. So let's connect these dots. How might the market view these things? The split, the financing. The sources hint it could stabilize or boost the stock price.
You have to take those suggestions carefully. A reverse split changes the price per share, but not the company's overall value. Right.
It doesn't change the fundamentals.
Not fundamentally, no. And while the financing provides cash, which is good, there's that dilution shadow we mentioned.
So where should people look for the actual stock performance data? Yahoo Finance, Bloomberg are mentioned.
Yes, those are standard go-to platforms. They give you the hard data price movements, trading volume, historical charts. You need that objective view, not just the company's narrative.
And what about analyst sentiment? The sources say these events might influence it. Where do you find analyst reports, and how should you read them?
You can often access them through brokers, financial news sites, sometimes directly from the research firms. But, and this is important,
Yes.
analyst views can vary widely. They have their own models, their own assumptions. It's just one input.
Not the final word.
Definitely not. And you need to see when the report was written, what their reasoning is. The due diligence piece even highlighted a discrepancy it found in ratings urging verification.
That's a good reminder. Always check the source. Okay, let's zoom out. The biotech sector. Famously competitive.
Very much so.
What trends in rare diseases and cancer therapy are relevant here? The sources mention competitors like Ironwood and Ardelyx in the GI space. What's that landscape like?
Well, in rare diseases, the big thing is orphan drug designation. Getting that from the FDA brings benefits like market exclusivity for a time, maybe faster review pathways. A big incentive. Huge. But proving efficacy in small patient groups is tough. For cancer care, the trend is definitely towards managing treatment side effects better, like the diarrhea Jaguar's targeting. It impacts quality of life, treatment adherence. It's a real need.
And the competition.
Companies like Ironwood, Ardelyx, they're established players in GI. Jaguar Health, being smaller and focused on plant-derived meds, is more of a niche player. That can be an advantage of unique products, but they're up against firms with much deeper pockets.
Which brings us to risks. Regulatory hurdles are always big in biotech, right?
Absolutely. Getting through FDA clinical trials, phase 1, 2, 3, proving safety, proving efficacy. It's a long, expensive, and uncertain road, Manufacturing compliance, post-market surveillance, too, it's complex.
And macro factors. Interest rates are mentioned. How does that hit a smaller biotech?
Higher interest rates make borrowing money more expensive. For companies that aren't profitable yet and rely on funding for R&D, like many biotechs, that can really squeeze them. Investor appetite can also cool off in that kind of environment.
But on the flip side, opportunities exist. Growing demand in rare diseases and cancer supportive care. How can Jaguar capitalize?
Success hinges on their pipeline. Positive results from that SBS-MVD proof of concept trial could be huge, especially if they get orphan drug status.
And the cancer therapy diarrhea.
Same story. If their on-target trial subgroup data looks good and they have a productive meeting with the FDA, that could unlock a very large market. It really comes down to the clinical data and regulatory execution.
The analysis document described Jaguar Health as focused on novel plant-derived prescription meds, mentioning crofelemer again for GI and rare diseases. They also emphasize sustainable drug development. Is that plant-derived angle a unique selling point?
It can be. It might appeal to certain patient segments or physicians. It could potentially offer different mechanisms of action compared to synthetic drugs. The sustainability angle, while maybe less directly impactful on the science, could appeal to ESG-focused investors, although the sources didn't detail how sustainable their process is.
Fair enough. The Nasdaq compliance issue via the reverse split came up again. Why is staying listed so critical?
Visibility, liquidity, credibility. Being on a major exchange like Nasdaq makes it much easier for investors to buy and sell shares. Getting delisted often leads to a stock price collapse and makes it harder to raise future capital. It's a big deal.
And that bridge financing, $3.448 million, convertible notes, 6% interest, just a 3-month term. Sounds like they needed cash quickly.
The short maturity and the fact it's bridge financing strongly suggests short-term liquidity pressure. Yes, they needed funds to tide them over.
The analysis flagged high dilution risk from immediate conversion options and a limited cash runway without more funding. Those sound like significant red flags.
There are definitely things potential investors need to consider seriously. High dilution means your slice of the pie gets smaller if those notes convert. Limited cash runway means they need positive news or more funding soon to keep operating. It points to a higher risk situation.
But despite those risks, there are those potential Q2 catalysts. The SBS MVD trial results and that FDA meeting on the on-target breast cancer data. Why are these seen as key strengths or events?
Because they represent potential major turning points. Positive data could validate their approach, attract partners or more funding, and significantly de-risk the company's future.
So a lot hangs on Q2.
A great deal, it seems. Negative results, on the other hand, could be very damaging given the financial constraints. These are often binary events for biotech companies at this stage.
Looking at the financials in the due diligence report, they noted Q3 2024 net revenue and some sequential growth. That sounds okay.
It's positive to see revenue and some growth quarter over quarter.
But
the report also pointed out constrained annualized growth and, significantly, a negative EPS forecast for FY 2025.
meaning they're still losing money.
Correct. It suggests they're still heavily in the investment phase, spending more on R&D and operations than they're bringing in through sales. Profitability isn't expected soon.
And the small market cap, how does that play against giants like Amgen, mentioned for comparison?
It highlights the scale difference. A small market cap means far fewer resources for research, marketing, everything. Competing head-to-head with an Amgen is extremely difficult. They have to be smart, focus on niches.
The due diligence did point to competitive advantages in cancer supportive care, mentioning Gelclair alongside the crofelemer trials. Why is that supportive care niche important in oncology?
It's hugely important. Cancer treatments can be brutal. Managing side effects like mouth sores, which Gelclair treats, or diarrhea, which crofelemer targets, improves patient well-being.
And potentially helps them stick with the main cancer treatment.
Exactly. Better tolerance can lead to better adherence to therapy, which can improve overall outcomes. It's a critical part of modern cancer management.
What about management? CEO Lisa Conte's long tenure is noted. Is stable leadership a plus here?
Generally, yes. Consistent leadership, especially someone who's been there a long time, like Lisa Conte, brings deep company knowledge, stability, and a consistent vision. In biotech, with its long timelines, that continuity can be very valuable for navigating challenges and building relationships.
Okay, pulling it towards a conclusion, the due diligence report recommended hold, high-risk speculative. It cited those Q2 catalysts as potential upsides, but flagged the financial issues and the make-or-break clinical results. It advised conservative investors wait for Q2 data.
That recommendation really sums up the situation, doesn't it?
It seems to. Why is understanding that specific risk profile, high risk, speculative, so vital here?
Because it sets expectations. This isn't a blue chip stable investment right now. The potential rewards are tied to clinical success. But the risks, particularly financial and clinical failure, are substantial. Investors need to be comfortable with that high degree of uncertainty and the possibility of a significant loss. Waiting for data reduces that uncertainty, but you might miss potential gains if the news is good.
And finally, that point about the discrepancy in analyst ratings in the report urging source verification. What's the key takeaway there?
It's just fundamental due diligence, really. Don't blindly trust third-party summaries or ratings. Go to the primary sources, company filings, press releases, the actual analyst reports if you can.
Yeah.
Cross-reference information. Be critical. Data can be misinterpreted or just plain wrong sometimes.
Okay, so wrapping up our look at Jaguar Health based on these materials, we see a company making strategic moves that reverse split the bridge financing to tackle immediate issues and fund its pipeline.
Focused on crofelemer for those rare GI diseases and cancer therapy diarrhea.
Right, and that focus brings big opportunities, but also significant hurdles. Regulatory financial stability, those Q2 2025 milestones, the trial results, the FDA meeting, they look absolutely critical.
Pivotal moments, certainly.
So for you, the listener, considering Jaguar Health means weighing those potential catalyst payoffs against the clear financial and clinical risks. As always, do your own deep research, look at multiple viewpoints, and think hard about your own tolerance for risk.
This has been our initial exploration based on the info you sent. We definitely encourage you to dig deeper into the specifics, check out those financial platforms, and absolutely keep track of those Q2 developments.
Does this raise more questions for you? What else might you want to investigate?
Always more to look into with these companies.
If you found this analysis useful, please do subscribe, like the video, leave us a comment. It really helps us figure out what topics you're interested in for future analyses.
Your feedback is appreciated.
Thanks for tuning in to Investing Talk Podcast.